Okay, now we in business. All right. I want to welcome everybody to Forex Profits. I am your master trainer, Angela Powerhouse Williams, and my trade scalping strategy is designed for you to be able to pull out $50 to $100 a day. Again, minimum. We have people that do $200, $300, $500, $1,000 a day. It is all possible with practice, consistency, and discipline, and sticking with the trade strategy. Now, this is session 3, and today is going to be all about candles. Yes, all about candles. And then next week, then we're going to do the Muku Cloud, the RSI, and then we'll talk a little bit more about being able to follow the big money, so just so you can become a smarter trader. Disclaimer, I am not a financial advisor. I will not tell you what to invest in or pick stocks for you. This training is for educational purposes only. Please be aware that all trading transactions can result in potential loss, and you should only be trading with disposable income and not leverage more than you can afford to lose. Information disclosure: you may not discuss, share, reproduce, copy, reprint, modify, rewrite, create, distribute, publicly display on social media, publicly perform, license, or sell content retrieved or learned from this presentation without the express prior written permission by myself, Angela Williams, owner of Financial GPS 360 LLC. Access to this class is by invitation only. So if you have anyone who might be interested, please let me know. Or obviously, if you are on my team in my econ, you know how they can get access to this class. So let's do a quick market in review. If we looked at the US 30, the US 30 has actually been everybody's friend this week. If we were actually to just look at our charts, I don't have the Muku clouds on this particular picture. Just the moving averages. Now, you already know that our trade strategy is quite simple. Whenever the candles are crossed and above the 200 and the 50-day moving averages, which is our yellow line and our fuchsia line, then we do a 2-candle confirmation. So I'm using this as an example. Let's say this bullish candle crossed over the fuchsia line, it closed, and when the body closed, it closed above the line. And then the second candle opened, and it opened above the line. So literally, as soon as that candle opened, I don't wait until that candle open and close, but as soon as that candle opens, I would hit buy, okay? And then literally you can hold it open, even though we have a resistance area here, but clearly there was enough volume to push through this resistance area, and it actually moved up into a uptrend. Now, how do you know that you were in an uptrend? Because as you can see, once there was a push up, it created higher highs. So it pushed up, higher high, higher high. This is a higher high. And then it went all the way to the top. So anytime there are higher highs that are created, higher highs, higher lows, then you know that you are in a uptrend. Also, if you look down at your trend indicator, it was all green, and it's been green for some time. And so when your trend indicator is green, and we are trading off of a 5-minute chart, so obviously when the trend indicator is green, then what you are doing is you're looking for buys. You're not shorting, you're not selling, you're looking for opportunities to buy and to buy low. And so the best thing to do is always catch the breakout trade. So remember, the moving average lines are designed to help you catch a breakout. So in this example, if you took this trade right here, clearly you were in the money and the markets did break out. All right. Now, once the market broke out to an uptrend, it hit its highest point, and then there was a pullback, okay? And the pullback usually can go back to the RSI line, the 50 moving average. Now, usually when that happens, that can be an opportunity for you to hit buy again. So if you miss the initial breakout, when the candles initially crossed over the line. If you missed it, you do not jump in, you do not chase candles, you let the candles come back to you. You are the moving average line. That's you. So when the candles come back to you, this was actually an opportunity to get in with another buy right here. And clearly it went up, but it stalled out. So if you got into this, you actually got a quick scalp opportunity, and then it started to fall back down. It never really established itself below the 50 moving average, and then it pushed up. But what you will notice is that we started to go from a uptrend into a sideways market, a consolidated market. Okay, so anytime you're in a consolidated market, the best thing that you can do is ignore the moving average lines because it's in consolidation. And what you want to do is you want to mark off the range. And so the candles establish the range for you. This was the high. So if you draw a horizontal line across, and then it established its low down here, but it tended to stall right here. If you look at all these candles, they all tended to fall along this line. So this became the low support. Okay, so this is the top, this is the bottom. So if you are trading, you want to do a buy off the bottom, and you're holding it open with the expectation that it will go back up to the top of the range, and it will. All right. Now, once it gets to the top of the range, remember, you're in a sideways market. So when the market is a consolidation and is moving sideways, there is no trend. There is no breakout. And so where a lot of people make mistakes is they see this candle right here broke out the top, and they automatically went in with a buy. And what ends up happening is you get caught, and the candle turns back on you. And as you can see, it was pulling back down. Why? Because the market was still in consolidation and moving sideways, even though a candle broke up out of it. Now, in order for me to take a buy, this candle would have had to break out the top of the range, but it needed to close on top of the range. As you can see, the body of the candle did not close on top of the range. It closed underneath the range. So I would have let this candle need to show me where it's going first. You have to wait for breakout candles to close to see where it's telling you. And so I would have needed this candle and the body to close on top of this breakout range. And then I need some more candles to come back down and test this range and turn this resistance into support. And if I see a candle with a wick at the bottom on top of the range, then it is confirming to me that we are now getting ready to go into a breakout, and we're going to continue the uptrend to the upside. Okay. But it's important, like I talked about last week, know when you're in a trending market and know when you are in a sideways market. I love sideways markets because number one, it's only going to go up and down within a range. But I also know after the market is done ranging, there's going to be a breakout, either to the upside or the downside. And usually it ends up maintaining the original trend. So I literally will be waiting for a breakout to the upside. Now, the longer a market is in consolidation, the larger the move is going to be. So it usually is some really big money. So I love to see it. And I love when the market is sideways, because that's an opportunity, again, for you to catch a lot of pips. Now, let's look at the S&P 500. Now, if we look at the S&P 500, at open, for the most part, the S&P 500 was completely sideways. There was no uptrend at open. It was completely choppy, up and down, up and down, up and down, up and down. And this will frustrate you because, again, if you do not understand that you are in a sideways market, you will find yourself trying to play these lines. You're like, okay, I'm finna jump in for a scalp, but I hit buy, and as soon as I hit buy, it keeps falling back down. I'm losing. And then you close because you're losing. Then you go here and you do a short, and you in it for a second, and then it break up and go the opposite direction. That is because you're trying to trade a sideways market with the moving average lines. And like I said last week, the moving average lines are designed for breakouts, uptrend or downtrend. When the market is moving sideways, ignore the lines, the moving average lines, and strictly map out the range. Again, the first high and then a pull back. So that's your range. So the first high and it started to fall back down, you draw your line right here. That's your first area. Okay? Then it pulled back. It went all the way down here, and then it created this long wick. Okay? And it stopped right here. So I'm gonna go ahead and I will draw a line right down here. Okay? Anytime you see some long wicks, that's just letting you know that the lower prices are being rejected. That's what it's telling you. And so now I got my top and I got my bottom. So what am I going to do? I'm going to sit back and I'm going to let the markets come to me. So what is the me? The top and the bottom of the range. That's me. So this was the top. This was the bottom. I already drew my horizontal lines. All right. Market moved up. I'm not jumping in a trade. I'm waiting for it to either go to the top or go to the bottom. I'm just going to sit back and watch. It paused here, which was a Fibonacci level of resistance. So if you got the Fib indicator on your chart, it is automatically drawn for you. So it hit this level of resistance, and then it fell back down. And what was it doing when it came back down? It's coming to me. It is coming to me. And so when that candles hit this bottom line here, and the next candle was a bullish candle, I'm going to hit buy right here. This is buying low, and I'm holding it open. So I'd have bought here at the bottom of the range. It moved up. It came down a little bit, but it didn't go back to the bottom range. So I'm still technically in the money, a little bit of profit, but I'm still in the money. It pushed up. It pushed up. It pushed up. I know the resistance is here right here, so it could be a pullback, and it did. It pulled back to the moving average, but I'm still in my trade because I got in at the bottom. It moved up, moved up, moved up. When it hit here, I closed my position out. Why? Because it's the range. I'm not holding it open, assuming it's going to break through the range. I'm going to close out. So now that I closed out and I see the candle stall at the top, why is it stalling at the top? Because there is a range. The market is moving sideways. So I can hit sell, and it went down. It went back up. It didn't go all the way up to the top. Broke down, came down here. And I could have closed out here if I wanted to. Whenever you want to take profit, I always say, when you're in the green, take it. Okay? Whenever you're in the green, take it. Sometimes people hold out because they're trying to get more money, and sometimes that causes you to end up losing trades. I prefer to ring the register when I get money. I love to take money because I always got an opportunity to get back in. I just got to wait for it, right? But let's say you didn't close out here. The market pushed up. Market came all the way down here, close to my bottom range. I will be looking to close out my position, right? What did the market do? It went back up here, tested the range again. This long wick, and a lot of people, because sometimes when the markets test the top of a range, I don't know why this keep doing that, more than 3 times, usually that 4th time, it busts through the range and it starts to create this uptrend. So I'm sure that there are some people who probably got caught in the markets with this move right here, because it was a long bullish candle. It went out the top. That top price had been rejected so many times that we just knew it was going to push up. And nope. And that is why you always wait for the candle that broke the range to close. If you waited for it to close, what did it do? It fell all the way back down, created this long wick, which already told you that the higher price was rejected. You would have shorted, and you could have went from here all the way to here and got out your position. So literally there were multiple trades that could be taken if you want to trade a sideways market. If you don't want to do it when a market is sideways, then guess what? You do not trade. So all you want to do is trend trade. You only trade in breakouts when the candles cross above both lines. It's a lot of volume and it's pushing it in one direction, either staircase or paintbrush, but it's creating higher highs and higher lows. Once you realize that the market goes to the top and then it moves sideways, don't trade. But if you mark it off and you know your range, you can trade the bottom and the top of the range. NASDAQ. Oh, NASDAQ. Oh my goodness, they made me so mad today. Woo. NASDAQ was pretty much sideways. If you look at the open, we literally right up in here, you guys. If you look at this, you will see that it's all in a range. It'll break out a little bit. And actually when it broke out, the area that it stopped at was actually a previous low area from the day before. So that's why if you draw your resistance and support from your daily and the 4 hour, you will probably see why the candle stopped exactly where they stopped at. Okay. And we'll talk more about that next week. You really want to know where big money is going. And usually big money is they're kind of predictable. Okay. But when the market's open, they broke down. So look at this. This was one big, gigantic, long candle. There probably was economic news announcements that happened today, which will cause these big, gigantic candles. Obviously, it was something happening in the news. And as you can see, the market is moving sideways, even though it broke out, because the second candle opened even above this area. So you would have never hit short. Okay. You wouldn't hit short. Because this candle is too long. It's probably had to do with economic announcements. I did not trade this morning, so I do not know what caused the candle of that size to happen. Usually it's economic news. Now, keep in mind, whenever there's a move that's made because of economic news, the markets will always go back to where it was prior to the announcement. So if there was some bad news, some bad numbers here, and it created this long engulfing bearish candle, guess what? It just wait for it. It usually happens in the next 5-10 minutes. The market will go right back to where it was before the drop happened. And that's what you see happen. Okay. It also, when it dropped, it tested the low of the prior day. If you were to actually zoom out of your out of your charts and look to the left, you would have saw this price point down here where these wicks touch. Okay. But look at this. If this ain't choppy, I don't know what to tell you. So if you lost money trading NAS today, it was because the market was moving sideways and you did not recognize it. And so what you do, you draw the bottoms, you draw the tops, and that's what you trade. It hit the bottom here, you do a buy, you in the money here to here. Or you can literally hold it open, even though it's going to, go up and down, but eventually it's going to touch the top. And that's what it did. So you could have went to the bottom of the range, to the top of the range. But you knew when you got to the top of the range, get ready for a sale. So you waiting for a bearish candle to let you know that it is being rejected. If you look at the prior time, it hit the top. It broke through, but where did the bodies close? They did not close on top of the range. So that's letting you know the prices are being rejected. It's going to fall back down and you can short. Okay. So anytime you're looking at the markets and it looks like it keeps hitting a particular price point and then it stalls down, that's a one way and it doesn't go back to the higher highs, is letting you know that the market could be going into consolidation, or the trend could be breaking and a downtrend could be occurring. But in this case, there was not multiple lower lows. There was only maybe one lower low or one higher high, 1 or 2 higher highs, but it's in a range. And this was the range. And another way to know that you're ranging, look down at your trend line. You see how little these bars are? The longer the bar, the more volume is in the market, the more money that's in the market, the more momentum that is in the market. So the longer the bars is usually an indication that the market is actually trending. The smaller the bars is usually an indication that the market is actually moving sideways. So that's just one way, again, for you to be able to see it. Okay. So let's go into candlesticks. The candlesticks, which is supposed to describe the psychology of the markets. Basically, candles is just how people feel. You know how people feel at any point in time by looking at the charts and looking at the candles. It tells you the emotions. Okay. You see green candles, that means people are happy, they're excited, they're optimistic, they're more likely to take risk. When you see a bunch of red candles, that means people are scared, people are frightened, people are exhausted, people are worried, and they're more likely to not take risk and take their money out the market. Okay, so that's all the candles are telling you. It also tells you who are in control. Who's in control of the market at any point in time, because who is in control will give you an idea of where price action could possibly go. Okay, now again, candles will only give you price action. That's it. That's all. If you are looking at a 5-minute chart, every candle represents the price moving up and down within a 5-minute time period. If you look at a daily chart, each candle represents the highs, the lows, the open, the close of that particular day. Okay. Now, what I do like about candles is, obviously, if you're in, let's say you are in a stock and you've been making money off that stock, obviously, if you look at that stock chart and you start to see consecutive back-to-back red candles, that is an indication to you that the price of your stock is starting to fall. And so you literally can make a decision. Do I want to close out, ring the register, and take my profits? Or am I a long-term investor and I'm going to use this as an opportunity to buy low and still hold the positions that I had prior? So those are decisions that you can make, but the candles is going to help you. Okay. Now, candles alone do not give you entry points of taking a trade. So if you jump in a trade just because you're looking at a particular candle, you don't have a trade strategy. You don't have a plan. You're just chasing candles. In the long run, that will not work. You will blow a lot of accounts. So what you have to do is you have to add technical analysis to the candlesticks so that you can get an idea of what is the best time to get in a trade. So that's why we have the moving averages. Okay, the moving averages give us an idea of where candle behavior and price could possibly go. There is nothing that is going to tell you when to buy and to sell and be 100% correct all the time. That does not exist. I don't care if somebody tell you they got the best robot in the world. They are not going to be right 100% of the time, because at the end of the day, there are market movers. There are market movers, market makers, people who, big money institutions that is moving this money. You can see them and they can see you. And so you are not as experienced as the most experienced traders out there. You are not more experienced than the computers that's out there trading for them. So there is no way for you to 100% know where they are going. They can make the markets move in whatever direction they want to. And just like you trying to reach into the markets and grab their money, guess what? They want yours too. And so that's why you got to have a plan. You got to have a strategy. You got to be smart. And then at the same time, you also have to incorporate risk management based on the size of your account. And that's why I talk so much about using low lot sizes. Don't jump out there with no $300 account thinking you finna trade a 1.00 lot size. You're going to get ate up and you're going to be mad. But that's gambling, right? That's why we follow a strategy. So let's talk about the basic structure of a candle. So when you see a green candle initially in your mind should tell you price is going up. So when you see a green candle, price is going up. And so when a green candle opens, this is the body and this is a wick. Okay. So the filled in area is considered the body. With a bullish candle, the candle opens at the bottom, lower, almost to the bottom, right? It opens at the bottom and then price moves up and it closes at the top. Okay. So that means price was at this point at a lower price. And by the time this candle closed, the price moved up to this point here. When you see wicks are just telling you the lowest price and the highest price at the time of that candle. So if we're looking at, again, a 5-minute chart, this is telling me that the price, when that 5-minute session opened, the price was here. It was $3, but it fell all the way down here. This is the lowest price. So it fell down to $1. That's the lowest price. And then it just started to move up. It went as high as $10. But by the time that 5-minute session closed, it closed right here at $8. Okay, that's what each candle is telling you. That's the price fluctuation in that time period. When you see consecutive back-to-back bullish candles, you are in a bull market, or you'll hear people say the market is going long. You will also hear people say the bulls are in control. So when there is a bullish market, bulls in control, a long day, that means that price is moving up and is usually in a uptrend, creating higher highs, higher lows. Now, on the opposite side is the red candles, okay? The red candles signal that price is moving down. Now, a bearish candle opens from the top. Remember, a bullish candle, price opens from the bottom. Why? Because you want to buy low. A bearish candle opens from the top. Why? Because you want to sell high. And remember, we have the ability to short the market. So if we think prices are going to go down, clearly we want to get in a bearish candle when it starts to form at the top so that we have a greater opportunity to make money going down. So it opens at the top and then it pushes down. Now this candle has a high wick and a lower wick. The top of the wick means that the price opened at, let's say $8, and then it pushed up for a second and it went to $10, and then it fell back down, started to create this body, and it went down and went down and went down, and it stopped at $4 right here, and then pushed down some more to $2, and then came back up to $4 and closed. Okay. And so obviously, if you're shorting the market, depending on when you got in the candle, whether you got in at the open or you saw it push up a little bit, but you knew based on your indicators, or you were in a range, you knew that the price was going to start falling down, you actually could have took a position at the top of the wick and rode it all the way down. Okay. When you see consecutive back-to-back red candles, you are in a bearish market. you are probably in a downtrend, creating lower lows and lower highs. Okay. So if you hear anybody say the bears are in control, that means all they seeing is red. Bears, short, it means the price is going down. Now, every candle can be in a different phase. How that candle closes will tell you a lot. Okay. So the first group of candles is if we're looking at bullish candles. Okay. So clearly, when you look at a candle like this, when it's a engulfing body and it has no wicks, it's nothing on the top, it's nothing on the bottom, that is basically telling you that the open and the low is the same price and the high and the close is the exact same price. When you see a candle that has obviously a wick at the top and the bottom, then you already know that the beginning of the body is the open, the close of the body, where the body closes at, that's the closing price. And when you see the wicks, you know there was a higher point before the close and there was a lower point even after open. Okay. When you see a candle like this, this is basically telling you that the open and the low is the exact same price. You see a candle like this, the high and the close is the same price. And then obviously the bottom of the wick is the lowest price it was. And it's the exact same thing when you're looking at the bears. Okay. You don't see no wicks, then you know the low and the close, same price, high and the open is the same price. Same here. You see wicks at the top, wicks at the bottom. The wicks at the bottom is the lowest price. Wicks at the top is the highest price. Then you got your open and you got your close. Okay. Now, if you're looking at daily charts, I like to see what candle is formed on the daily because that'll give you an idea of what the next day could possibly be. But I also do like to make note of the high, the open, and the close of the prior day, because you will find that the markets tend to go back and retest what happened the next day. And when you start to see it, it makes it a little bit easier for you to know where the money is going. And again, if you see a candle like this, the low and the low, the close, the open is all the same price. The highest price is at the top of the wick. And you see this final candle, the high and the open, and it's the same price. I'm sorry. Then the close is at the bottom of the body, and the lowest price for that session was at the bottom of the wick. Okay. Now, anytime you see a candle that has a very small body but very long wicks, that is a signal of pressure. Okay. So if you see a candle where there is a small green body, but there is a super long wick at the top, okay, that again is telling you that the higher price is being rejected. That means the bears is jumping in the market and they are bringing that price down. Or it could be that people are ringing the register and they're closing out their positions and they're getting their money, causing this very long wick. It is usually an indication that the uptrend may be about to break and it is about to reverse and go to the opposite bearish direction. Okay, so whenever you see a candle looking like this and it's at the top of an uptrend, you want to be paying attention. If you see a candle like this, where again, it's still a small body at the top, and then there is a long wick at the bottom. What that is telling you is that yes, there is some buying pressure there, but it is a signal that we just might be moving to the upside, but you might have hit a level of support. So usually you'll see a candle like this at the bottom of a downtrend and it hits support and then it creates a long wick at the bottom. So that's telling you that after the bears and pulled the markets down, the bulls and jumped in and they trying to raise the price up. Okay. The opposite side, same thing. you see a bearish candle, and you see these long top wicks right here. That is literally, usually you might see that after an uptrend where the candles hit a higher level of resistance, and then a long candle at the top starts to form. You know how I was talking before where I was talking about that range, and I talked about how the candle pushed out, but then there was a long wick at the top. Again, that is an indication that you might be getting ready to move to the downside, okay? And the same with the other candle. Again, you still may see this as a level of support, and it's just letting you know that the lower prices are being rejected. So when you see any candles with long wicks, pay attention. Now, what I want you to also understand is that there are momentum shifts, and the candles can give you an idea of when a reversal could possibly about to happen. Remember, the size of the candle matters. And so if you look on the left-hand side, where we're talking about bearish momentum decreasing, remember when you see back-to-back red candles, that means that it's a move to the downside. But if you have a long, big body candle, this is an indication of a big downward momentum. If the next candle, even though it's red, you notice that the body is not bigger than the first candle, that is letting you know that the momentum is starting to slow down, okay? So that move to the downside may be about to break. And then when you see the tiniest candle, that is letting you know is very little downward movement. And so usually if you start to notice if you got your support levels, which means that the price is going down, if you got it drawn out, or you're using the Fibonacci indicator, you will notice that you see here, you got a long engulfing bearish candle. Then you got another candle that's red, but it's smaller than this first one. And then it got down to the bottom, and this one's smaller than the previous one. And you even see wicks at the bottom of the candles. This is an indication that this support has been tested, and it is a potential signal that the downside may be ending and the reversal upside is about to happen. And you see it right here. It started to push up, okay? So once again, right here, gigantic candle, smaller candle, smaller candle. And then when it got right here, it was a bullish candle. It went from red to green, but it's a bullish small candle here at the bottom. Even though it pushed down a little bit on the support level, it went right back up. And this is another way you see where it is testing support multiple times. So that's why you always do your homework. Always look to the left, because you'll always see where the markets retest a previous low again. Here's candles. And you see this, you see a long candle here, but look at this candle, tiny. That means that the bears are losing steam. They're losing steam. Here's an example, the opposite direction. If you're looking at a bullish candle, again, you see big old long engulfing candles. Guess what? That's a strong move to the upside. A lot of money in the system, a lot of momentum to push it up. If the next candle after that is a smaller body, and at the top is an even smaller body, that is an indication again that the bullish momentum is starting to lose, okay? It's starting to lose. And you will usually notice it at the top near resistance levels, okay? Engulfing candle, smaller engulfing candle, smallest engulfing candle, and then right after that, you saw a red. That's an indication of a pullback about to occur, and that's exactly what you saw. Okay? Big old long candle here, smaller candle. Always pay attention to the size of the candles, especially when it's in an uptrend and it's back-to-back-to-back candles. Pay attention to the size, because that can give you a clue of what's happening in the markets. Again, understanding candles. When you see a candle, full body, no wick, that is called a strong engulfing bullish candle. Prices going up consistently. All right. After an uptrend, if you see this candle here, where the body is at the bottom, a long wick at the top, this is called an inverted hammer. If you see this, usually if you see it at the top of an uptrend, it is a signal of higher price rejection, and the next candle could possibly be a bearish candle to the downside. Anytime you see a candle where the body is in the middle and there's equal length wicks on the top of the bottom, that is called a spinning top, and literally the bulls and bears are fighting, but there is a slight edge to the upside. Okay, so when you see a spinning top, pay attention to the next candle that forms after it. This candle is, you see the body at the top, you see a long wick at the bottom. If you see this after a downtrend where the price has been back to back red candles, it got to the bottom, and all of a sudden you see a bullish green candle and you see a long wick at the bottom, usually the very next candle after that will be another bullish candle moving up to the upside. Okay. You see a candle look just like a spinning top, it's just a little bit smaller. Again, this is a reversal candle. So if you see this after an uptrend, you see how tiny that body is, you know they fighting. Usually the move right after that is a move to the downside. Again, opposite direction. The markets is constant showing red candles back to back. The market in a downtrend. You see these big old red candles. This is an engulfing strong bearish candle. Prices are moving down. If you by any chance see this candle right here, and let's say if you see this candle where the body is at the bottom and there's a long wick at the top, if you see that towards the bottom of a downtrend where it looks like they tried to push up, but it got rejected and it created a long wick, that's usually an indication that the next candles are going to start falling down more. Okay. If you see a candle like this, again, you got the red body right in the middle. You got your wicks at the top. They kind of equal length. This is called a spinning top. This just means that the bears and the bulls are fighting. Nobody is truly in control, but there is a slight edge toward the bears. If you see a hangman, okay, actually, if you see this, sometimes you can see this at the top of an uptrend. You can see this at the top of an uptrend, and I call it's a hangman, but when I see it, it almost looked like the top of it is like a hammer and it's hitting the top of a candle and it pushes it down. Okay. If you see this at the bottom of a downtrend, the next candle is going to move up. So it all depends on where you see it. Do you see it in a downtrend, or if you see it in an uptrend, will give you an idea of where the next candle could possibly go. And again, we have another candle where the body is extremely tiny, long wicks on both directions. Again, this is a spinning top. This is a reversal candle. So if you see this at the bottom of any trend, look for, especially if it's after a downtrend, you might want to look for an uptrend to begin. If you see it at the top of an uptrend, it's quite a possibility that the market is about to break down. So anytime you see spinning tops, those are reversal candles. My favorite is what we call dojis. And basically dojis is bodiless. they don't have no body. It's almost like a bunch of wicks, but no body. All right. It's really tiny. So right here, this is called a long-legged doji, and which means indecision. So if you ever see this, and a lot of times you might see this on the daily, or you might see a lot of dojis when there's really not a lot of money in the marketplace. Okay, so in the middle of the night, you might see these dojis because there's no volume, so it ain't nobody fighting. It ain't nobody really moving prices. It's just doji means indecision. So when you see candles like this, there's a fight and nobody is in control at the moment. Okay. With this long-legged indecision, you really don't know if the market is going to go up or if the market is going to go down. My favorite doji is called the Dragonfly. This right here is always on the money. If I am investing in stock and I am looking at the daily and I see this symbol on a daily, I'm buying that stock, because right after this, the stock price is going to start to shoot up. And so anytime I see a Dragonfly doji, I immediately take that trade, even if it's for a quick scalp, because 80% of the time, the price will move up. Now, the opposite is the gravestone bearish doji. Now, I used to think that if I saw this gravestone bearish, that means that the next move was going to go down. That is not always true, and especially when you're trading indices. So I found that you have a 50-50 chance of the next candle being bearish. So when I see gravestone dojis, I don't even take them. I just wait and see what the next candle does. Okay. If you see this candle here, not this candle, this doji where it's just a very tiny horizontal line, this is extremely rare. Again, you usually see this when there's no volume, no money, no nothing in the middle of the night. That basically means that the open, the close, the high, the low is all the same price. They not moving it nowhere. Okay, so if you see something like that, there's no volume, so why even be there? All right. And then another favorite of mine is just a simple doji. When you do see a simple doji, that is an indication of a trend breakout. I noticed that when I see a doji, there's a breakout right after it. It's either going to go up or it's going to go down. You just wait for it. So when it comes to dojis, I only trade one, Dragonfly bullish. Now, another favorite, and I know Patricia Samuels, if she's on this class, her favorite is she loves to trade tweezers. All right. And you'll kind of see tweezer tops if you pay attention to candles and they body formations. And the way the tweezers is there's a bullish candle and a bearish candle. So there's a green and a red candle. Now, if the open and the close of both of these candles is at the exact same price, you see this right here, you can literally draw a line. All right. There is no wick at the bottom. The close of the bullish candle, the open of the bearish candle are the exact same price. And then you're going to see these wicks at the top of the body. Now, this kind of looks like the wicks are the same size. Sometimes they're not the same height. One may be a little bit longer than the other. The reason why you recognizing it is because the open and the close in the same price, and there's wicks at the top. If you see this, okay, after an uptrend, so that means that the market's been moving up, up, up. If you see this, the next move will go down. It is an indication of a break in an uptrend, and the reversing trend of a downtrend is about to happen. The opposite direction, flip it over. Here, the open of the bearish candle and the close of the bullish candle are the exact same price, and the wicks are at the bottom of the candle, long wicks at the bottom. If you see this, after a downtrend where the market's been going down, 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 and you see this happen, this is called a bullish tweezer, because that is going to be the break of the downtrend, and it's going to start moving to the upside. And as you continue to study the markets, like, you don't have to trade every day, but you should be looking at the markets every day. And you should be looking at the candles every day. And you should be looking to see how markets move based on candles, so that you can raise your IQ on trading. Okay? Every candle is also going to every candle got to move. It's telling you to move. So again, if you see a long engulfing candle, it's red, it's going down, which means that prices were moving down. But then you see this wick form at the bottom. What is that? That's telling you, okay? that means that that lower price is being rejected. So that fear from the downside is starting to break a little bit, and people are considering getting back in the markets and buying because the pricing went low enough. Remember, you buy low, you sell high. If you see a candle again, long wicks at the top, small body, confusion, they're fighting. But again, there is a preference to the downside because the body is red. Here, we got a long wick at the bottom, tight body at the top, okay? That means that the bulls and jumped into the market and they're trying to prevent the price from staying low. They ready to move the prices up. That's telling you. And if it's after a downtrend, it is letting you know that it's going to be a reversal to the upside. That's why I love candles with long wicks at the bottom of a downtrend. Okay, that's the only time I might counter trade. All right. Anytime you see a candle like this, remember, wick at the top, small red body at the bottom. That just means that the higher price is being rejected, and quite possibly a downtrend is going to continue. You got the opposite happening. Green candle at the top of an uptrend. You see that wick at the top. Hey, the bulls, the bears is like, wait a minute. I don't want to. I'm ready to jump in. Y'all moving the price up too high. You know, I'm finna go ahead and I'm finna ring the register and I'm finna get my money. So I'm gonna go ahead and close, and that's gonna create this little wick. Okay. So that just means that there's a fear to the downside, even though it could continue to move up, but depending on where it's at, it might be moving down. This is the same thing. There's confusion between the bears and the bulls. There's a slight edge to the upside. You see this here at the top of an uptrend. That's letting you know that the market is about to reverse and go to a downtrend. If you see this at the bottom of a downtrend, long wicks at the bottom, that is an indication that it's a possible reversal of the downtrend and is going to move up. Now, candles can make a particular pattern, and this is just giving you an idea. You can always screenshot this page. There is, so if you see, for example, this is an indication of patterns that's about to be bullish, which means break out to the upside. So right here at the top, this first one on the left-hand side, you saw back-to-back red candles, and then you saw my favorite hammer at the bottom. So you see a bullish candle, long wick at the bottom. That's an indication that price is going to what? Push up. That's what you see. All right. You could also see a downtrend, and then you may see an inverted hammer. But because the body is green, it could be an indication that the price is going to go up. Now, if this was red, it's probably going to continue to fall to the downside. Okay. If the markets is moving down, and then you see a long-legged doji, my favorite, it's called Dragonfly Doji. Guess what? The next move is going to be to the upside, and you got an 80% chance of this being right. If you see how this is 3 bearish candles going down, but you see this a large candle, this a smaller candle, this the smallest candle, indication that the momentum is breaking. And then you saw this big old green candle that literally ate up the last 2 red candles. That is an indication market's about to move up. Pearson line, market move down. The bearish bullish candles pretty much the same size, and it could be a move to the upside. Morning star, you got back-to-back consecutive candles. You see this small body wick. It is green though. It is a move to the opposite direction. This turned out to be reversal candle. Red, and then you see a doji. So anytime you see consecutive red candles, you see a doji. The doji is a symbol of a reversal, and you saw it going to the upside. Okay. If you see it, a red candle coming down, you see a small body green candle followed by 3 consecutive larger body candles, is usually a move that an uptrend is about to start. But sometimes it can push back down on you and then continue the uptrend. So I don't always take a trade just because there's 3 back-to-back bullish candles. But they call this the three white soldiers. This doesn't always hold true when you trade in the indices. Bearish candles. So you see you in an uptrend, and then at the top of the uptrend, you see a long wick at the top. You see a red body. What is that telling you? That's a shooting star. Price action is going to fall down. Uptrend going up. You see a hangman, which looks like a hammer, basically. You see it in red. That hammer going to knock that other candle right on down and push it down. Here we got moving in an uptrend, and then we got a graveyard doji. And remember, it's the opposite of my favorite doji, but in the indices, you got a 50% chance that it actually go down. I have seen this graveyard doji in an uptrend and seen it continue to go in an uptrend. So that's why I wait for a candle to form before I decide to actually short the market. Again, we got a bearish candles. We got an uptrend, green candle, real small green candle, followed by a longer body bearish candle, which ate up the last two green candles. Then guess what? It's going to move to the downside. We got our dark cloud. Price action moved up, and then you see a red candle right after a green candle, and it started to break down. But what you also can see here is that the close and the open was actually the same price. So this is actually also let you see what a tweezer can look like. Evening star, same thing, uptrend. Then you see this small body, red candle, red body move to the downside. Uptrend, doji is always a reversal. You see the opposite happening. Just like there was the three white soldiers, there's also the three black crows, which means that the price is going down. Again, this is not always true in the indices. I do like my favorites are hammers. Those are my favorites. The hammers, the inverted hammers, and the dragonfly dojis. Those are my favorite because whenever I see it, 9 times out of 10, it ends up going in the right direction. So again, I like these. I look for wicks, candles with wicks at the bottom after downtrends, because those are your indications of reversals. So again, you in a downtrend, you see a candle with a long wick at the bottom, guess what? It's going to push up. Downtrend, you see a candle with a high at the top, but it's green, the body is green, it's going to the uptrend. After an uptrend, you see a candle with a long body at the bottom, it's going to almost look like it's going to hit that candle and drop it all the way down. You see an uptrend and you see a candle with a long wick at the top and it's red, it's going down, okay? So even if you look at this, the market was kind of moving sideways, but you notice as the market was moving sideways, it is multiple candles with wicks at the bottom. That is an indication that a move to the upside is going to happen. And it pushed up right here, okay? It moved sideways, it pushed up, create higher highs, higher lows, boom. At the top, what do you see? You see your candle with the long wick at the top, red body. That's an indication that price is being rejected at the top. And that's what happened. It ended up going from here to here. But even though it tested it, because you see these wicks at some point were bodies, and then it fell down. But this was an indication that that higher price target was actually being rejected. Here's an example. Price moved up, got to the top, right up in here. We got a hangman. Price reversed, fell down, moved sideways, fell down, move sideways. If you start looking, you will start to see this happen in front of your eyes. Again, you're looking at candles. So the market is moving sideways. Then the market pushed up. It pushed out from moving sideways. It broke out to the upside, created higher highs, back-to-back green candles. Boom. Wick at long wick at the top. Red body, what happened? Price action started to pull back. You see it right here, okay? Let's say the market is moving sideways. We got resistance, we got support. It went down, it went up, it went down, because you see this candle at the top. Every time you see them candles at the top, the next candles usually are lower, pushed down. You see these candles at the bottom. Okay, so how do I know that a support is established? At some point in time, these candles went out, it broke out the bottom of the support, but then it came back in and it closed, and the body closed on top of the support and left these long wicks. These are indications that the lower price action is being rejected. So I'm going in with buys here to here, here to here. Broke out, wick, fell down, move sideways. We got another doji that's basically telling you that there's going to be a reversal from the downside, pushed up and broke out. You'll start to see patterns as you watch the markets enough. And my favorite is double bottoms and double tops. Anytime I see a double top, that means that the price action moved up. It created a high point and then it was rejected. It went down, it went back up, test that high price again. You could literally draw a line across the top, and then it fell down. Usually if it's a double top, when it fall down, it will break and it'll go way, way down. Same with a double bottom. Price action went down, it stalled, created this low, the lowest point, moved up, higher price was rejected, fell back down, test that same low point again, previous low. Then as it push up, it's going to eventually break out and continue to go to the upside. Okay. Head and shoulders moved up, down, created a higher high, came back down, test that previous low, broke up a little bit, still didn't go higher than the highest high, broke down, and it will continue to be a breakdown. The rising wedge, you probably would have saw this a lot today in the NASDAQ. You saw it yesterday in NASDAQ as well, where there was an uptrend and it literally was just choppy. It was choppy, but even though it was choppy, it still was creating higher lows. And then what it do, it fell back down. So all you need to do is, like I say, take snapshots, print these out. They should be in your binders or they should be in your wall. That way, when you're looking at the markets, look up and see, do I see a pattern? And if you see a pattern, it can kind of give you an idea of what could possibly happen next. Nothing is 100%, but it is a great possibility that this is what's going to happen. Anytime I see a double top, anytime I see a double bottom, it does exactly what it is shown to do. Okay, so again, print these out. We got falling wedges where there was an uptrend, pull back, it went up, it didn't go as high as the higher high, broke down, created a lower low, up again, a lower high, boom, a lower low, and then eventually it's going to break out to the upside. You saw this in NASDAQ as well. A bullish rectangle is there was an uptrend and then it was choppy. This is also like a channel, the market moving sideways, and you're waiting for it to break out and continue the original trend, which was a uptrend. Okay, and then there's the bullish to the upside, because even though it was kind of choppy, it's creating higher highs, higher lows. It's lower highs and higher lows. So it kind of looked like a flag. It's going to be going to the upside. Again, print these out, look at the markets, and you will be able to see the continuation trends happening right in front of your eyes. Okay, so this bearish rectangle is just like the market was moving down and then it went in consolidation, went into a range, and then it breaks out and continue the original trend. Again, here's an example, a bearish rectangle. Down here, you got a reversing candle, long body wicks. Long wicks at the bottom of candles after a downtrend or moving sideways. I don't know what's going on with my mouse. There's a breakout to the upside. So the market went in consolidation. Then it started going in an uptrend, going into accumulation. And then it started moving sideways. This is nothing but sideways. It went up. It was up. We had a reversal candle here. It went down to this lowest point. Reversal candle here. Went up, went down, broke out, came right back down, hit this low, another doji, broke out, and then it continued the trend, the original trend, to the upside. Okay. Another pattern that you may see is what they call a cup. They call it the famous cup. Okay. And literally, you can just draw a line to show the price action, and it looks like a cup with a handle. Okay. So clearly, there is a bearish move to the upside. It hit a support level. It started to fall down, move sideways, fell down, move sideways, fell down, move sideways. Now, it didn't go all the way to the bottom of the lowest low point. It did not. But it went down almost between, it could be anywhere from 15 to 50% of that resistance, that high peak right here. So this little dip can be 50% of that high. Okay. And then it starts to make its way back up, move sideways, and then continue the breakout uptrend to the upside. So this is called a cup. And this is an inverted cup, which you just turn the cup upside down. Okay. So clearly you got a downtrend. Price was high. It fell all the way to here. You see some wicks at the bottom of some candles. It started to move up, move sideways, move up, move sideways. This one didn't go back as high. This probably could have been 20% move from the original upside. It moved sideways for a very long time, fell back down, moved sideways, and then broke down and continued the original bearish trend. So you literally can just draw a line and you will see it start to form. So what is your homework? What's y'all homework? Okay. Y'all homework is to look at the markets. You guys, I look at the markets every day, all day. Well, I ain't got no job, so that's all. I ain't got to do nothing. So I'm just going to look at the markets. But literally, I look at the markets and can get a real good idea of where it is going because I look at it enough and I've studied it enough. Like I said, you print these out, you put them on your wall, put them on your computer. And when you're looking at the markets, look up and see if you see any patterns. Under the files, if you look under the files, you will see a chart pattern handout. Print them out. There are some chart patterns that I put under files. So go under files in the Forex group and you'll see something that says chart pattern files. Download them and print them out and put them on your wall. Trust me when I say, when you start looking at the markets, it's all going to start to click and make sense the more you look at it. I don't go into the market specifically to trade. I go into the markets to see what the market is telling me. If I see my setup, I take it. But if I don't see my setup, I don't take it. I just watch and I look at the behavior and I'm like, oh, this is what they're trying to do. And then eventually it'll start to make sense for you. And you will start being able to kind of predict, but remember, it's never 100%. And it ain't never what you think. Always remember, you have zero control of where the market's going to go. Zero. None. So don't even try. Just let them come to you. So your homework is to download these pattern cheat sheets, print them out, put them on your wall. And your homework is to start looking at candles and see, do you see reversal candles? Do you see certain patterns forming? And also take your practice trades, okay? Under files, I also put a video on how to use the online journal. Journal your trades so you can get an idea of when is the best times for you to trade. When you won, what was the pattern setups when you won? That way, when you see it again, you'll know what's going to happen and you can take it. If you want to be a professional, you got to track it. So whether you're using the online worksheet, I put a video out there, and I also shared my my worksheet table if you wanted to use that online table, Airtable version. It is under files. Everything you need is under files. Go there. Every time I teach this class, I record it and I replace the original video, the video that was there from the last time I taught it is replaced with the new video. Okay, so if you haven't been watching, 9 times out of 10, you might not have no idea what I'm talking about, because every time I teach this class, it's just a little bit different. Okay, so that is your homework assignment. Take your practice trades, and I definitely want to give a shout out to Rashad Brown. We call him Tuck. Rashad is trading in his live Forex account. Rashad was able to turn $9,387 into $74,878, and he did it in 3 days. Now, what you'll hear him say is that he did a swing trade. Okay, so basically what he did is he still used the strategy. He used the breakout strategy, but he let it run. And people who are swing traders, they may leave their positions open for a day. They may leave it open for 2 days, 3 days, what have you. Again, this is more of a riskier play, but he was able to get in at the initial breakout, and he was able to ride that baby. He rode it. He did the Aussie versus the US dollar, Great Britain versus the US dollar. He caught it. You know, so if you catch the breakout, you catch the breakout. Now, he is trading at a 3.00 lot size. So, ladies and gentlemen, this is not something that you're going to do at home, okay? Clearly, he got $9,000 in his account. If you're not going to have $9,000 in your live trading account, this is not what you're doing, right? But what he did is, once he got in the initial breakout and it continued to move and continue to create higher highs, he opened up multiple positions. So that's why you keep seeing back-to-back positions of the Aussie dollar, because every time it created a new high, he took another trade. Okay, and as it continued to go higher and higher, multiple positions. So you can have five, 6 different open positions in the same direction. The key is getting the direction right, catching the breakout. You catch the breakout, you can literally hit buy or sell back to back to back to back to back, where you got 5 positions open at the same time. Okay, and you can take this same approach even if your lot size was 0.01. You catch a good breakout and it start moving, it move up, move sideways, and about to move up again. You hit buy again. It move up, move sideways, finna hit go up again. You hit buy again. So you can have multiple positions so that you have leverage. And clearly, again, this is not a demo account. So he's not paper trading. This is real money. People get real results. And what I will say, when you make money like this, now see, he good. This don't work for me. It doesn't work for me because I'm a scalper. I'm so used to getting in and out, I can't even let a trade run. Okay. So when I got to 25,000, I might have pulled out, well, it depends on if I caught the initial breakout and it's still moving up, I probably would have stayed in, but I'm just saying, I might have got to 20,000, 30,000, and I would have closed out my position. So clearly he was still moving. He was still letting the money happen. And he caught an amazing breakout. And was able to turn 9,000 into 74,000. And, some people don't make $74,000 in a year. And, he was able to make this in 3 days, you guys. And so what I'm saying to you is take it serious. learn the strategy, take the trades. But at the same time, have your risk there. Because he ran these trades all night, like I say, with me, I would probably, you got to have some type of target to get out, just in case it turns against you, because just as well as you can be up 70,000, it could be a pullback and you end up with 35. And that is because you didn't ring the register, because you was hoping or thinking that it was going to continue to move up. Remember, I always told you, you don't know how high a market going to go. You don't know how low a market going to go. So when you get money, ring the register so you can enjoy your profits, and then take this money out and put it into, you can put it into some more stocks. You can put it in your emergency account. You can go buy you a car and not have no note. You can do a whole lot of things when you take your trading serious. And so shout out to Rashad. I'm proud of you. Everything that I tell him to do, he absolutely do it. Like I said, he was already a millionaire, but yet he still joined my econ because of the wealth of information that you get. And the fact that I know my trade strategy works if you work it. And I am literally giving you guys the opportunity to change your life. You got to want it. You got to do the work. You got to practice, and you going to get good. And one day it's going to be you. Understand, ain't no competition. Don't look at this and be like, this got to be me, or I need to do this. I need to rush. I need to hurry up. No, take your time and learn. Because if you go into a live market and you still not confident and you still ain't mastered it, guess what? You're going to blow your account. You got to go right back to the drawing board. You're going to be mad because you blew your $100, $200, $500. I've blown thousands upon thousands upon thousands of dollars in order to get the level of discipline that I have right now. And so you're going to have to go through it. Ain't nothing this easy going to come easy. You're going to go through it. You're going to have up times. You're going to have down times. What I will tell you is become emotionally detached to money, especially when you lose money because of something you did. So don't get mad. Just take it as a learning lesson and do better. And that's why in my econ, we teach you to manage your money, and you income shift and you stack your cash. That way you got money to fund your trading account. You ain't working off little accounts. You got thousands to put in because you are prepared for it. You have managed your money and prepared for it. That's the thing. Do not treat this as gambling. Don't treat this as I'm finna get in and get rich. That's not what it is. You can get rich, but it's over time. The minute you start gambling, the minute you start getting greedy, the minute that God bless you with thousands of dollars and you don't close out your trade because you want more, God gonna take it from you. And then you're gonna be hurt. But that's just to bring down the ego and to get you back into discipline, because God rewards discipline, you guys. Discipline and work. That is it. And that is all. So we are done. We are done. We are done tonight. And I also posted in the Forex group as well, even though it was my futures account, it wasn't my Forex account. But the post that I put in is that for the month of July, I had made $20,000 from trading. What I'm saying to you is that my goal is always $1,000 a day. If I grab $1,000, I'm done trading for the day. Now, sometimes it might be 2,000 because that particular trade went to that level. It might be 2,000, it might be 3,000. But I don't like to get money and then be like, but I want to get some more. Because the minute that happens, I lose what I had, and I'm going to tell y'all this because even though $20,000 was made for the month of July, I had 31,000. So I want to make sure you get that. I had 31,000. So God gave me 31, but I was being greedy. Now, what was great is God let me keep 20 because God could have took all of it and I had to start from scratch. Okay. But I'm not bummed out because I know I did it to myself. And so when you understand that, I'm not emotionally attached to it. Okay, yeah, I lost the money, but I got 20. All right. So let's see what August do. But I start all over. You move your money out. You start all over. That way you don't blow the money, the profits that you and got on the house. So for people who gambling, when you gamble and you make some money, that's the house money. So I like to gamble on the house money, not my money. So I take it out. And then you start trading again for the next month. But the point of doing that is discipline. Because if I leave the money in there, I'm more likely to say, you know what, I'm gonna trade some more contracts. You know what, I got 20,000. Let's go. You know, so to avoid that, you move it out. You start fresh every single month, because that's what works for me. Now, the way I trade and the way somebody else trade may be totally different. Some people have the discipline to leave their money there and just grow their accounts up. You know, because I literally, I could leave it there and then add another 20 for August, and then I'll have 40,000. Then I can have 50,000. I could do that. I'm trying to see if I'm mentally gonna do that, you know, and without taking big risks, because obviously when you have bigger accounts, I can take a drawback. So literally the Dow could drop 100 points. I'm not gonna blow my account, and I could ride it back up. I can do that when you have big money, but why do that? Okay. What I will tell you is that when you start losing, do not think that the market can't go lower. You know, so when it start going down, don't be like, you know what, it's gonna go about right here, and then it's gonna come back up, and then you realize, and it went down a little bit more. You like, it can't possibly go. Then you be mad as I don't know what. And if you got a little amount of money in your account, you're gonna get the margin calls. You don't want them margin calls. They're gonna kick you out that trade. They're gonna make you take that loss, and you're gonna have to start all over. So what I prefer to do is take little losses. So if I see that I'm in the wrong direction, I'm clearly, you know, when you're wrong, you know it, you see it, you be like, why I do that? That didn't even make sense. Why did I do that? Because sometimes I take a trade off of emotions. Try not to trade with emotions, but sometimes you be like, it's finna go here. Then you be like, why you do that? That was dumb as I don't know what. But when I'm in the red, I don't want to be, I'd rather be down $200 than down $2,000. You get what I'm saying? Hoping that it would have went back in my favor. Now I'm down 2,000. And then because you down, you like, I'm finna win my money back. I'm finna go right back in here and I'm finna win my money back. And you went from being down 2,000, now you down 4. That's what happens. And so I'd rather take a little loss, sit back, take a smart trade, make that money back, than to be so far in a hole that you start to feel discouraged and feel like I don't get it. And I must don't understand. And then you get scared. Because when you get scared to take a trade, you're going to always get in at the wrong timing because you're emotionally tied to it. Okay. And so again, be mindful of those lot sizes. I see y'all out there, y'all be in them big lot sizes. That's not realistic, especially if you open a small trade account. I know you don't want to make $50. You prefer to make 500 or 5,000. But sometimes you got to take them baby steps, build your account. Then you're going to be able to ball. Because guess what? The markets ain't going nowhere. They're going to be there a year from now, 5 years from now. You got time to make money. I have already failed for y'all. I'm telling y'all, if you can lose 14,000 in a day, me. If you can lose 14,000 cash in a day and still don't give up, then you know you're doing the right thing. Now, how can I take that type of loss? Well, I'm in my econ. I'm build my business. I get amazing checks every month. So if I mess up, what is my econ going to do? Give me the money to fund my account again. And I start all over again because my econ money is on autopilot. So that's why I tell y'all, do not build your business, because that money will come in handy. But now I just make money. I'm not losing, but I was losing then, but I had to learn. So what I'm trying to do is get y'all to where y'all don't do what I did. So you got to listen. Trust me when I say, ain't nobody smarter than that big money that's out there. They see your trades. When y'all get out there and y'all put y'all stop losses, they see your stop loss. They know your stop loss is there. They will drive the market, take you completely out your trade, and then go where you knew they was about to go, because they can do that. Okay. So sometimes we try to be smarter than them, but we can't. So what we try to do is, instead of jumping in front of the train, just get on the train and ride it. Okay. All right, y'all. I will put the replay of this tomorrow. Oh, for people who got Androids, tomorrow I'm gonna upload a video of how to put your charts on an Android, because I know people was asking me. I don't know why y'all got Androids. I really wish y'all would get some iPhones. I think that that should be your Christmas gifts. Everybody get an iPhone. You ain't experienced nothing until you got an iPhone. And so I only knew how to do the charts with an iPhone, but people with Androids, I'm like, I don't know what you asking me for. I don't know. But I had to borrow somebody's phone so that I can do a video so that I can show Androids how to do it. So everybody gonna make enough money in their live accounts because they buying iPhones for Christmas. So y'all buying iPhones and Apple stock. Remember, I told y'all, don't forget the Apple stock split. You got to be on record by August 23rd. Buy your shares, because for every share that you own, you're going to have 4. So if you got 1 share of Apple, you're going to get 4 shares of Apple. So I hope y'all buy, even if you're doing fractional shares. If you can't afford a full share and you do a fractional share through Stash, whatever you have in Stash, it's going to be multiplied 4 times. All right? All right, y'all. See y'all next week, and y'all have a good weekend. Bye-bye. Woo, I'm ready to eat, y'all. I'm finna go to bed. Good night.
Good night.